Okay. Okay, so everyone who's going to watch this later, welcome to the open call. We are Wednesday, June the 3rd, 2026. Okay, so do we have some questions apart from that thing about the interactive brokers, just sort of more on markets or trading in general? No?
Can you hear me, Angus?
Yeah, is that Kim?
Oh yeah, I can't. I'm on my phone. I'm late getting home, and I'll turn on my camera as soon as I get to my desk. I
Okay.
just I can't turn off the microphone. I can't turn on the camera. It's on my phone. But anyway, thank you. Um, I want to ask about options and bonds. Which
Options
one?
and bonds. Okay, that's a very large
I
sort of
know. Tell
subject
me all
there.
about all about options and all about bonds. No, I want to ask. Well, for one thing, the trade you did. I just started reading and realized that what you said about the central bank, or realized when they're talking about the Fed changing the interest rate, that it's all just going through the banks, and I never realized that. And then you had that post about your trade with the yields when they had the bond auction,
Right.
and the trade was to sell one and buy another.
Okay.
And I just wondered how that worked. I couldn't quite figure out exactly how you knew to do that. I know that's a
Uh,
lot, though. That's a lot.
no, okay. So that's a large question because essentially your question is what okay, the bond yield
Oh,
curve, how does that work? And probably more importantly, and more practically, how can one profit from that? So I know that some of you guys have more knowledge of that. So the thing is, Kim, that's a very large subject, and I can't, it's literally like 10
of
hours.
course.
But having said that, the key thing, the very simplistic way to look at it is just to understand that when we talk about bonds, we of course have to think about duration. So the front end of the curve and long bonds. So let's say like a 2-year bond, or actually a 2-year bill or note, and a 30-year bond. And just to keep it simple, and the main thing you should take away is that when we talk about the Federal Reserve or any central bank, their decisions generally impact the front end of the curve. So the shorter duration bonds are most significantly. So therefore, but obviously the transmission mechanism is that will, let's say a bond, an interest rate sort of going higher or lower, that will eventually sort of filter out into the what we call all along the curve. So it'll start off with the short-term bills. So let's say like a 1-month bill or a 3-month bill, then a 2-year bond, a 5-year bond, a 10-year bond, and a 30-year bond. But obviously, I was speaking to John, for example, the other day, and obviously a bond which has 30 years of duration, it is less affected by what happens immediately. So the point is that the thing to keep in mind is that different tenors, as they're called, TENOR, the different tenors or durations, they have different levels of sensitivity to central bank interest rate decisions. So therefore, the question can also be like, okay, so what are the factors which, in broad sense, move the bonds? So what we can say is that we have to say, well, okay, what affects a short-term bond more than, let's say, a 30-year bond or a 10-year bond? So the thing is that let's just start at the long end. Generally, the factors which most affect a 30-year bond or a 10-year bond is kind of like you have to imagine almost symbolically projected to the future. So it's kind of like what is going to be the future path of uh, of inflation, because what is going to be the future path of economic growth or economic what's the opposite, sort of decline. So they're the things which most affect the 10 and the 30-year bonds. Whereas something like the front end bonds, that's going to be more affected like immediately by the shorter term interest rate, which is affected by the Fed. Does that make sense so far? Okay, so
Yes.
so the point is that all bonds are correlated. They all move together. It would be quite unusual if, let's say, the 2-year bond is moving up and the 30-year bond is going down. So this important thing to keep in mind here, Kim, and everyone, is that when we talk about curves of bonds, it's a relative value, relative differences. Okay, it's not like, oh, the 20 years going to go up and the 2 years going to collapse. No, no, all bonds generally going to move up and down together, but they're going to move at slightly, shall we say, different magnitudes or different speeds. So the question is that if you have in terms of trading, if you hear anything, and that could be, let's say, data releases, so new data, geopolitical information, central bank sort of commentary or central bank decisions, all of these things are going to move bonds, obviously. But the question you have to make is, I mean, if you don't want to do a spread trade, so selling one and buying the other one, a relative value trade, you're probably best to sort of stick with what they call the belly of the curve, which is basically the middle of the curve. So let's say like a 5-year bond, or maybe the 10-year, maybe not so much the 2-year or the 30-year. You want to avoid its extremes. So what I'm trying to say is that if there's any particular reason you want to be short or long a bond, maybe just choose something relatively neutral, which would be, I don't know, the 5 or the 10-year, which if you're trading with futures, that would be something like the ZF, the 5-year, or the ZN, which would be the 10-year. Okay. Now, that's all very good. So there's nothing wrong with doing that. But what is sort of, how can I say, slightly, I would say, a more nuanced, institutional, sophisticated way of trading is to maybe sort of is to do a sort of a spread trade. Okay, so those who know me know that I love doing spread trades, and the point there is that one of the reasons for doing that is that you're essentially isolating the reason, like specific reason, that one instrument, one bond will outperform the other one. Okay, so let's say, for example, you have a 2-year bond auction. Okay, the U.S. Treasury sells bonds, on a weekly basis or on a monthly basis. So let's say, for example, next Tuesday at 1 p.m. when the bond auctions happen, and it's the 2-year auction. So let's say, for example, the 2-year auction performs badly. The market demands a higher yield. It wants to be more compensated for that. Now, what's going to happen to the bond market? Question. If it goes badly, what's going to happen? It's going to go down in price, right? It will go down in price because the auction has been poorly received by the market, and that's going to push up the yield. But the point is that, okay, you could short that. That's one way of trading it. But another way, which I would argue is slightly higher probability, is to say, hey, this is not great news for the bond market in general. But what should happen is that the front end of the curve, let's say, for example, the 2-year in this case, it should underperform. It should underperform, let's say, the longer end of the bond market. So in that particular case, if you're sort of good enough, fast enough, knowledgeable enough, you would maybe, for example, short the 2-year bond, and you'd go long, let's say, the 30-year bond or the 10-year bond. Okay, and your basic sort of premise here, the basic idea of this trade would be to say it's underperformance. So essentially what you're trading there, you don't really care how much they go down or how much they go up in absolute terms. You're trading the relative difference, right? It's kind of like the spread. And the good news about that, let's say, for example, you get a tweet from Trump, or you get some kind of headline or whatever, both of them, because they're correlated and move together, they're going to move in a slightly different, they're going to move more or less together. Okay, so you're not going to be shaken out of a trade. You're trading the relative value. So that's one example of, let's say, a spread trade on bonds. Another one, for example, could be if, let's say, I mean, okay, so what particularly affects sort of the bonds? Let's say, for example, the Fed, let's say, for example, Kevin Warsh comes in, the new head of the Fed, and he gives a speech or whatever. You've got the press conference on June the 17th, which is upcoming. And let's say he's sort of hawkish, just, simple example. Let's say he's hawkish. Now, is that going to be good or bad for bonds in general? Bad, right?
Yeah.
Because it's essentially, he's like, guys, I don't like inflation, and I'm going to start attacking the inflation problem by, advocating for a higher sort of interest rate. Okay, hawkish. Now, obviously, at that point, what's the trade? Pretty simple trade. And again, we're just keeping to bonds here. Obviously, there's all kinds of other trades. But at that point, you could short the bonds. But again, the logic, and people who know me know I always like to invoke this sort of, pretty simple metaphor, shall we say, of the doctor and a fever. And again, I was talking to John about that the other day, is that, if the Fed chairman comes in and says, we're going to sort of be hawkish, all bonds are going to go down. But the thing is that the front end of the curve, which is the most affected by that, because it's an immediate effect, that will take the brunt of the pain, so to speak. It'll be like, oh my God, that'll go down. Now, the long end, let's say the 10 or the 30-year, will also go down in price and up in yield, but not quite as much, because the sort of the logic of the long end of the curve will be to say, the Fed is being more hawkish. They're combating inflation over the period of, let's say, 10 years or 30 years. Ultimately, that should bring down inflation. So ultimately, it's a bit annoying, let's call it in the short term, but over the medium to long term, that's actually not as bad for us. That's maybe even slightly good news. And so therefore, what we would see is that the short-term bonds would come down a lot more than the long-term bonds, which would also come down. And that would cause the curve, you see, it's a curve, that would cause the curve to have a certain dynamic. So in that case, you would short the front end, go long, let's say ZB or ZN, so the 10 or the 30 year. And basically the logic there is that the front end of the curve would come down more than the other end, and your profit would be the spread difference, 5, 10, 15, 20 ticks. And in terms of the curve, what's going to happen? Think in the opposite way in terms of the yield. So as we know, when prices come down in bonds, yields go up. But if the front end yield is going up a lot more than the back end of the curve, that means that the front end is going to be higher. So that means it's going to be going down like that. This person's called Chloe's funky dad. Okay, admit. That's going to be what we call a bear flattener, because the front end curve of the curve, the yields have gone up more than the back end. So that means the shape of the curve is going to be sloping downwards, right, from left to right, which would be a flattener. Okay, and there are many other things as well. Does that make sense? I mean, I'll give you some other quick examples, not too much detail, but let's say, for example, what's good for the back end of the curve? Less inflation is good for the back end of the curve, right? So lower inflation, ordinarily, the long end of the curve should outperform the front end, although not as much there. But also, for example, let's say the Treasury, the economy is good, the Treasury doesn't have to issue a lot of long-term bonds. That would be potentially good for the long end of the curve. Right. So the thing is that if you're talking about bond spread trading, what you need to first understand are the different factors which affect more the front end and the back end of the curve. And then when you see those situations in real life, and that could be anything from Fed speaking or bond issuance, auction results, geopolitics, all that kind of stuff, then you can also do spread trades, which are kind of more stable way of doing things, right? Does that make sense a little bit?
Yes.
More questions?
Okay.
Anyone have
Wrap
any
my
more
head
questions?
around which end of the curve it's on. You think about which end of the curve this will be.
For what
for you.
particular situation? Because the thing is, what you have to understand, Kim and everyone, is that often the bonds will more or less move together. But the thing is, I mean, let's look at an example. I'll just bring up some charts here. So let's and the way to think about this is also to think about the let's just go and look at let's have a look at bonds. Okay, so can everyone see the chart here, guys?
Yes.
No.
No, you can't.
Yeah, you can.
Yes.
Yes.
Oh,
Okay.
okay. Well, I'm on my phone. I'm trying to change the computer. That's probably why I can't see.
Okay. So let's just look here, guys, and let's just look. So the point is here that okay, so this is the 2-year. This is not the yields. This is the ZT, so the 2-year futures. Everyone understand that? Okay. So the point is here, and again, I don't exactly know who, but let's have a look. So since the war started with Iran, we can look here, and we can see that what's happened to the 2-year note. It's gone down. So over the past, whatever it is, couple of months, let's just say like well, actually, we'll go to the low. We'll go to the low. Now, how many ticks has that gone down? It's gone down 424. You see this? 424 ticks. Agree? Guys, a bit of feedback would be good. Anyone? You agree?
Yes.
Right. Okay. So why is the 2-year gone down a lot since the war in Iran? Why has it gone down? Okay, we'll do it as a rhetorical question. It's gone down because obviously energy prices have spiked up, and so what's the sort of the chain effect? The chain effect is that as energy prices goes up, that's going to raise real inflation, also inflation expectations, and the logic there is that the Federal Reserve and other central banks will be obliged maybe to be less accommodative with their sort of monetary policy and potentially not cut rates, definitely be on pause and maybe even hike rates. So that's very much affecting the front end of the curve, okay? Now, let's just check that. And again, it's interesting because the point is also that it's not always obvious, but the curve will give you information. So if you look at we can see ZT since the 2nd of March has gone down 424 ticks, right? Now, if we look at the back end of the curve, let's look at the Ultra bond. Now, the Ultra bond is for the 20-year bond, the real 30-year bond, okay? If we look there since the war, now what can you guys notice? You can also notice that it's also gone down a lot, right? Agree? It's gone down as well. But what can you notice here? You can notice that it's gone down 361 ticks. 361. And also what you'll notice is that it's had a pretty nice rebound. Look at that rebound, guys. See this rebound in the last couple of weeks? Now let's compare that to the price action of the ZT. Going back to the ZT. Have we had a rebound? Yeah, but it's been much more modest. And also we noticed that it's gone down about 20, 30% more in real terms. Okay, so what does that mean in terms of the curve? What is that telling us? Let's just first of all understand what it's telling us in simple English. No bonds like inflation, right?
Sure.
No bonds like inflation. But the point is that the logic of the market is that in the short term, this is going to cause central banks globally, and in this specific case, the Federal Reserve, to maybe hike interest rates more aggressively. So therefore, more pain is being felt at the front of the curve, which is more sensitive to potential reaction function of the Fed. Now, if you sort of think from a trading perspective, we wake up, I think it was on the Sunday evening or the Monday morning on the 2nd of March, and we go, okay, Trump and Israel have decided to, obliterate Iran. You go, maybe the Iranians, in an extreme case, will reduce traffic flow through the Strait of Hormuz. We all know there's about 20% of the world's oil. It's going to be inflationary. Therefore, the Fed will not like that and will have to hike. So as a trader, if you're a good trader, that immediately should go through your brain. Now, there's all kinds of trades you could have done with, the US dollar, gold, equities, blah, 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 whatever. But I'm saying let's say a bond trader, you could say, what's the chain of logic? A, inflationary, bad for bonds. But the problem is you have Trump tweets and tweets from the Iranians and the Israelis and other stuff. And so there's constantly the problem about being shaken out of trades, of too much volatility. If you like calmness, like me, and you like to be calm, and you like higher probability trades, you can say, you know what? This is inflationary. The Fed and other global central banks are not going to like this. I believe that, big picture, this should be worse for the front end than the back end of the curve. It's going to be bad for the back end of the curve. So there's nothing wrong with shorting the ZB or the Ultra bond, nothing wrong with shorting the 2-year or the 5-year. It's all good trades. You would have made money on all of them. But all I'm trying to say is that one way of looking at it is to say, hey, I'm going to short on this inflationary pressure, the front end of the curve. At exactly the same time, simultaneously, I'm going to go long the 30-year. And I believe that over time, there will be a differential. Now, let's see if this happens. I don't know. I could be very wrong here. But let's have a look. So how can we look at that? We're going to look at the spread. Let's look at the spread now between them. So that would be, in this case, let's say the 2s to the 30s. Actually, the Ultra bond is a bit more extreme. So I'm going to look at the 2s to the 30s. Let's have a look. Okay, there it is. Can everyone see this beautiful chart? Can everyone see this beautiful chart?
Yes.
Okay,
I
so
can't, unfortunately.
okay, Kim, you're having some tech issues. Okay, now look at this beautiful chart, guys. What is this beautiful chart telling us? Look at this. So first of all, we need to isolate. When did the war begin? The war began kind of
End of February.
there we
End
go,
of
basically about here-ish. There we go, right here. Now, what can you see here, guys? We can see that since the war began, which looks like, there we go, there's Monday, the 2nd of March. You can see that the equivalent, it went down 40 basis points. You see here, this 39 here is 40 basis points. So the point is here, guys, that the curve flattened. Now, it did go up and down a little bit, but basically it's been a flattener, okay? And that's what I was trying to say. This flattening of the curve, what does that mean? It basically 40 basis points, right? So that is telling you the differential there. If there was no differential, that line would be straight. It wouldn't be flattening or it wouldn't be steepening. So those 40 basis points, which is 0.4%, for those who don't know, that's basically saying that all of the yields have gone up. But the 2-year yield went up 40 basis points more than the ZB, the 15-year bond. Okay. Now, if you don't believe me, we could also do another little experiment, and we can look at, let's say, just the outright yield. So this is another way of looking at it. So again, look at that. This is the 2-year yield. So again, let's look at the experiment. So we go, when did the war start? The war started on the 2nd of March. And we can see at the extreme a couple of days ago, it was up 80 basis points, 0.8%, right? Because of inflationary pressures. Now, so just keep that number in mind. Let's call it 80. Now, if we look at the 30-year yield, look at this, guys. Now, did it go up a lot? Yes, it did. But you can see it's not nearly as much. And if we actually look at the beginning of the war, you can see here, look at this, guys, about 56 basis points, not as much. And you can also observe that over the last, let's say, 10 trading days or so, the 30-year yield has come down a lot more. So if we were actually to compare it today, look at this. The 30-year bond is only up 38 basis points compared to a lot more for the 2-year. Okay, that is a spread trade in bonds. You're basically saying that this bond, for various reasons, is more sensitive to various bits of information than this bond. So I'm going to trade the outperformance. So think about this spread trade. It's like, you know, it's like sort of trading OpenAI versus Anthropic or something. It's kind of a semi-bad example, but it's a relative value trade. Okay, and there's a lot more we can say about that, because you could do spread trades. Again, I was talking to John about this the other day. You could do spread trades between Italian bonds and German bonds, and the 2-year German yield and the 30-year German yield, and the US bonds and the German bonds and the UK bonds and the Australian bonds. There's thousands of different ways of doing all these spread trades. But that's that. Okay, let's get on to another question. But as I say, Kim, there's obviously a lot more we can talk about that. It's a relatively complex subject, but that will give you maybe an aperçu, a little sort of, you know, introduction to it. Was that useful? Hopefully a little bit. We'll see. Yeah, okay. Kim's gone. Okay. Next question, guys. We have a question about markets or what's on anyone's mind.
Can we get like today's macro, can we analyze today's macro data and how that affected the bond market?
Okay, so what was today's data? Today's data was, well, first of all, we didn't have
ADP.
ADP. Okay.
ADP non-farm employment change. We had the S&P Global Composites PMI.
Yeah.
And
the ISM services.
ISM non-manufacturing, prices, employment, all that. ISM manufacturing.
Yeah. Okay. So the first thing to keep in mind when we talk about data is, well, first of all, we have to understand what is data, hard data, and John, what is soft data or surveys. So the first thing we need to understand when you're talking about data is to understand, I would say, what it is exactly, and possibly even more importantly, from a trading perspective, what is the market focused on? So let's start with the second question. What is the market focused on? It's very important when you're looking at data to understand that the market, as I used to say in the old days, is like a 12-year-old boy, an intelligent 12-year-old boy. Very short attention span, very focused in the short term on certain things, and then it ignores it. Okay? The point being that at various times and various days, the market is more interested in certain things than other things. Okay, so the first thing, if we want to talk about today, is to say, well, okay, what are the priorities for the market today? Is it ADP weekly data? Is it the ISM services or non-manufacturing? And is it what was the other one you mentioned?
S&P Global Service PMI.
Right. Yeah. Okay. So the first thing to understand is that okay, so ADP, what is that? It's a weekly number. Is it super is it super correlated with the non-farm payrolls? Not too much. In fact, they actually suspended it a while ago. And without going into all the details, it's a private survey. ADP is a very large payroll company. So it gives useful information. But I would say it's just part of the jigsaw puzzle. It's one sort of piece in the mosaic of employment data. So it's interesting. We had JOLTS yesterday. We had the ISM manufacturing on Monday. We had ISM services today. Tomorrow we have initial jobless claims and continuing claims. And then, of course, what the market is really interested in, John, what the market is really interested in is the non-farm payrolls number on Friday.
This Friday.
So the first thing we need to understand in terms of relative importance for the bond market is how important is the ADP number? It's like, it's a little piece of the jigsaw puzzle. Is it correlated to non-farm payrolls? Not particularly. So I would say it contributes a little flavor to the sentiment. Now, it was strong today, if I remember. It was a little, I think it was like 120,000 or something like that, 150.
122 and 118 was expected.
Okay, so that's nice.
4K.
Right. So the point is that interesting to the market if it beat by 4K? I would say, I would say it's in line. So it's not particularly soft. It's not particularly higher than expected, but it feeds into this narrative that the job market is solid. So it's kind of like, okay, what is the narrative? Remember that markets move if the narrative needs to change. Does that move the narrative today? No. It contributes to the idea of a solid job market. Good. But by itself, it was neither a big beat nor a big miss.
Yeah.
And by itself, it doesn't have enough prestige because it's a slightly flawed number. Okay. Second data we had today was the S&P Global numbers. Now that's interesting because the S&P Global PMIs, Purchasing Manager Index, surveys, not hard data, survey.
Yeah.
You realize this is a bunch of questions, right?
Yeah.
Purchasing managers, which is super important, they go, oh, let me fill in the questionnaire if I have time. By the way, since COVID, most surveys, the numbers of people actually answering the surveys has gone down about 50 or 60%. So a lot of people are saying that a lot of this survey data is a little dubious because it's just less and less people are actually responding to all this stuff. Anyway, let's leave that to the side. Keep in mind today, it was the second reading, John. Second reading. Market likes timely information. Not that interesting. We're like, dude, we got the first reading 2 weeks ago. Okay? So not so interesting. What is interesting about the S&P Global PMIs is that it's global, the same methodology all over the world. So it's interesting that you can compare that to other countries. So it's interesting. And I would say, looking at it from memory, it was relatively robust again. So again, we're just feeding into this narrative of, hey, I mean, what you have to step back and say, but we'll get there in a second, the big picture. And the third piece of information we got was the ISM services. Now, ISM, Institute of Supply Management, the market historically takes that very seriously because that's been around since, I believe, the 1930s from memory. And that is data. Again, it's not data. What do I mean by that? It's a survey. It's what we call soft data. Okay, so don't confuse surveys with hard data. Okay, non-farm payrolls this Friday is hard data.
Yeah.
ISM and S&P Global PMIs are surveys. Important. They're part of the thing. Now, what did we get today? We got the headline number was good. New orders was good. From memory, the prices paid was elevated, but slightly lower than expected. Yeah. And then employment was a little better than expected, but still under 50, which means contraction. So, okay. So the point is to say, so the question is, what is the big picture everyone's actually looking at the moment? What's the big argument in the global macro and markets? On one hand, this is what I've been saying on my morning videos. It's very simple, guys. You have one very powerful engine of growth, which is a capital expenditure on AIs, data center, hyperscalers, very wide profit margins for these big tech companies, et cetera, et cetera. I think we all understand what's going on with semiconductors, et cetera, right? I think we all get that. That is a very powerful, but a very narrow leadership engine for the indices. Of course, remember that when we look at the indices, like especially the S&P 500, keep in mind that, you know, it's essentially being driven by, I don't know, 8, 10, 12 companies. So it's narrow, but it's powerful. It's real. But is it overextended? At the moment, it's doing the hard work. Now, what do I mean it's doing the hard work? Most companies, I'm sure you guys have seen all these charts. If you look at any chart of the S&P 500, which excludes, let's say, your NVIDIAs, your SMH, your semis, they're pretty flat, right? But it's okay because these big companies are doing so well, they're kind of chugging along. Great. But what's the competing narrative at the moment in markets? The competing narrative is that energy prices are causing inflation. Inflationary pressures are causing central banks around the globe to pause and in some cases to hike, but certainly not to cut. That eventually could be a headwind. So the big battle is very simple. There's just a binary simple battle going on in markets at the moment, is that the equity market's going, okay, we're kind of powering to new highs because of all of the AI stuff and the tech stuff. But we're sort of looking over there at the bond market, because the bond market is looking at higher inflation expectations and is basically pricing in a more aggressive or a less accommodative central banking policy. And so the big question is, at what point, if the Fed starts hiking or at least not pausing, the Reserve Bank of Australia hiked, the Reserve Bank of New Zealand did a very hawkish hold. The ECB, European Central Bank, is going to hike next week, probably also in September. At what point will this gradual accumulation of central bank hikes start to sort of pressure the equity market? That's an open question. And that's why at the moment we don't quite know. So why am I saying that? I'm saying, John, that when we look at, how was the economic data today, you have to frame that in the sort of you have to nest that within the context of, does the data today answer either of those two questions? So does it tell us much about AI? Maybe not too much, but what it does tell us is that it seems that the employment data at the moment, and ADP today and ISM services and ISM manufacturing on Monday, the employment is pretty good. It's maybe not amazing, it's solid. And we had the same thing with the JOLTS number yesterday, that basically people aren't hiring a lot, they're not firing people a lot, we don't have much immigration in the US. So, I mean, a lot of the numbers I've read say that we only need in the US to build about 20,000 jobs, new jobs every month. It used to be 150,000, just to remain even. So why is that important? That's important because it means the Fed has its two mandates. It doesn't really have to worry about employment. It doesn't have to go, oh my God, we have higher inflation expectations, but we have a collapsing labor market, therefore maybe we should be cutting. The Fed very tranquilly, including the new guy, Kevin Warsh, can look at the labor market, the employment market, and basically go, hey, that's pretty solid. We don't need to worry about that. It's not just like unemployment rate 6% or 7%. It's 4.3 or 4.2. It's all good. Therefore, the Fed can focus on what? It can focus on the problem with inflation. And in terms of inflation, the whole question now is really, okay, is it just sort of temporary? Are we going to have the Strait of Hormuz reopened and energy prices will come back down, drop like a rock, as Trump likes to say, and food prices? Remember, the Fed is much more concerned about core prices, not energy and not food. So the question today is, what did it tell us about employment? It tells us it's solid. Hello, Altaf. Good to see you. Hope you're well. Bit late, Altaf. We're about to finish up here soon. That's okay. All right. Now, then the question is, what did it tell us about inflation? Do we have inflation numbers today? Not really. What we did have was the input prices for the service sector, and that's still at 70. It was about 70, if I remember, right? a little lower than expected. So that you could argue that's slightly positive, but still elevated. So that's not great. So in terms of the bond market, I would argue that the bond market, there's not a huge amount of new information at the moment. The bond market is very correlated, I would say, more to probably oil prices, to be honest. I mean, let's have a look at that. How would we check that? Let's look at, let's say, December pricing for the SOFRs, you know, the short-term interest rates. So I'm going to look at, can you guys see, this is the 3-month SOFR. So this is the 3-month bills for December. Can you guys see this chart?
Yes.
I imagine yes. So John, to answer your question, on a daily chart, look what happened to the SOFRs today, of the last 2 or 3 days. But today, let's put it on a 3-minute chart. Now, again, this is saying what they think, they'll say what they think the Fed will do in December 26. And that's not great. So if we put it on a 3-minute chart, which is generally not the best way to look at SOFRs, but let's say a 3-minute chart, what is that telling us? It's telling us, well, actually, it's difficult to see in a 3-minute chart, but basically it went down today. Okay, so you can see here that the front end of the curve, the extreme front end of the curve, is clearly worried about inflation, and also is looking at the general economy, the real economy, and saying, hey, it's pretty strong. We had higher than expected factory orders, talking about data today. We had higher than expected factory orders. We had robust ISM services today and manufacturing on Monday. We have a pretty good job market. If someone plopped down from planet Mars and said, hey, how's the US economy? I think you'd have to say pretty good. Pretty good, Mr. Martian. So the point is that for the Fed, and the market is telling the Fed, it's saying, look, guys, you need to hike at some point. Now, let's just compare this. I'm kind of curious. Let's just actually put the price of oil here on top of that and just see. Hold on. Let's put oil futures and just see if they're correlated. Now, what I'm going to do, guys, I'm going to reverse oil. It's inversely correlated, obviously.
Yeah.
I'm going to invert it. So I've inverted the oil. So you can see how highly correlated they are, right? So basically, guys, actually, it's interesting here. There's a little bit of, that's interesting, the divergence for a few days just there. That is quite interesting. But in general, what we can see here is that the higher oil prices go, energy prices go, the more the bond yields go up. So the point there is that the bond yields are very much focused on energy prices and the general economy. So to answer your question, I would say, how did today's data affect the bond universe? I would say the bond universe looks at that and goes, no crazy new information, but it confirms a robust labor market. It confirms that pricing pressures are still very elevated in terms of the input prices into the ISM services, which is what we got today. And the factory orders were strong. So the real economy and construction is doing pretty well. So if I was the bond market, and we see that the bonds all today were in general trading heavy, we're now up to 4.5% on the 10-year and 5% on the 30-year. That doesn't give a green light at all for the bond market to chill. And then, by the way, the bond market looks over to the oil chart and goes, oh, that's still, let's just call it sticky and elevated. It's not collapsing like a rock. So again, not a huge amount of new information. And I would say, the trade I did today, guys, was just like, targeting. You've got to be looking at the moment, even if you're trading equities on like even intraday, be looking at the bond yields, because they're very key pivot points. If we look, hold on, let me just get rid of some of these guys. Okay, so let's say, for example, we look at if we look at the 10-year yield, you can see here, you see how important the 4.5 level is here. That's the pivot point. When it broke through a couple of weeks ago, it ripped higher, it had down resistance, and now it doesn't quite know what to do, but it's now there. That's the pivot point. And the same thing is for the 30-year yield, it's the 5% level, right? which, let me just get rid of that. So you see the 5% level. Very, very key. Anything above 5% in the 30-year or 4.5%, you've got to be, if you're trading anything else, you should keep an eye on those, the 10-year and the 30-year yields, because if they start ripping north or above 4.5 on the 10 and 5% on the 30-year, the equity market increasingly becomes under pressure, especially the long duration equities. Some of this frothier sort of tech stuff as well is not going to like that. So that's my answer to that question. Okay, one more question. Anyone has another question? From Juan, newbie question. What is the beige book and why does it mean in small net negative? What it mean? Thanks. Issues with my microphone. Okay, Juan. I'll do a little video about that, the beige book. I'll make a little video for you. But basically the beige book, actually, I'll do a little video for that. But the beige book in 2 minutes is essentially the 12 districts for the Federal Reserve. Each district, about 8 times of the year, they bring together essentially commentary from the real economy. So for local businesses, business leaders, and they talk about conditions in the various districts. A lot of the evidence is not highly statistical. A lot of it is anecdotal in nature, which means it's basically people telling stories. They go, hey, in the Kansas, we saw that there are a lot of import prices. I will make a little video about that, which I'll post. But essentially, it gives the Federal Reserve, let's say you're Kevin Walsh, it's like a snapshot of real business conditions in the different sort of districts for the Federal Reserve in the Federal Reserve System. And from the Fed's point of view, it gives you sort of a real-time view of like what's happening in the real world, in the real economy. Yeah. There's Kim, I think. Hi, Kim.
In the barn.
Okay, you have a lot of nasty reverb. Okay, Juan, just by the way, I will do a little 4 or 5 minute video about the beige book. Okay, guys, another question. Any other questions about stuff, markets, trades?
Angus, can I have a question, like a beginner question? I'm just
No problem.
starting,
All good.
planning to start the trade like with a small risk, like $20. So a couple of small questions. If you were starting trading from zero today, what would be your focus for the first 3 months? What is your daily pre-market routine? How do you connect macro view with an actual trade setup? And maybe
Okay,
can you give an
that,
advice?
all of that takes about 10 years, but okay. Literally,
Simple
number one-
trading setup for a beginner?
No. Okay. First of all, don't rush. Don't rush, okay?
Okay.
Yeah, so don't rush. I mean, two big questions, and Pascal actually asked the question there. In terms of the daily setup, I suppose the point is, and again, these are massive questions, Vitaly, very, very complex questions, so I'm not going to pretend to answer them in 2 or 3 minutes. But what I will say by guise of a sort of introduction is that there are many, many, many different ways to trade, right? So the first thing, and a lot of that is a function of your interest, your account size, your technological skills, your psychological profile, et cetera, et cetera. It's very different. I used to work at a hedge fund. It's very different from working, let's say, a hedge fund with algorithmic traders and 20 people in the algorithmic team with, hundreds of millions of dollars. Okay, very, very different to being a day trader with a risk parameter of $20. Okay, now, so first of all, you need to first of all not confuse your personal situation with other people's situations. You need to understand your place in the ecosystem, which is a very broad question, but it's important. Okay, so in terms of the daily routine and how to connect macro to micro, again, very complex questions, but the thing is, you have to understand what you're trying to do. So, for example, when I was at the hedge fund, and a lot of the strategies were purely systematic, right? Algorithmically driven. Zero macro input. I would talk to the quants, the quantitative guys, and one of my roles was to interrelate with them. But talking to the quantitative guys, they would say, who's Jerome Powell? Who's President Trump? I mean, they knew who Trump was. But basically, they didn't care because it was all statistical analysis based on price action. So the point is that you don't need to understand macro. In fact, most of the big hedge funds in the world who actually make money, let me qualify that. You could do systematic macro trading, but you can do just purely systematic, whatever. My point is that there are different ways of doing stuff. If you want to be, let's say, a retail day trader and you're interested in macro and fundamentals, I would say the question is the following. First of all, it's time frame. One of the biggest problems people have who are interested in macro and fundamentals is that they take big macro views and then they try to trade on 3-minute charts. And again, Vitaly, it makes a lot of, it's very, very important to understand your time frame as well, right? So for example, I was talking to John again the other day about copper. I was like, oh, what's the macro fundamental view? Well, we have AI, we have data centers, we have the grid being built around the world, electrification of cars. Oh, that's great for copper. Yeah, that's wonderful for copper long term. But that's a macro fundamental. Who should trade copper that way? You should trade copper that way if you have at least $1 million minimum, and your time frame is maybe 6 or 12 months, or 2 years, or 5 years. You're an investor, or if you're a hedge fund, you say, we're going to buy a bunch of futures and we're going to roll them over for the next 5 years. Okay? If you're trading intraday copper, you shouldn't care about that. That's something in the back of your brain. So let's look at the copper market. And just something, because I was trading this myself today and talking about it a little bit. Just give you an example. So let's go to the copper chart daily. And the point I'm trying to make here, Vitaly, is how to turn macro knowledge into maybe making money, hopefully. So here's the copper chart. Now, we know the big picture for copper. What is the big picture for copper? Long-term, medium-term demand. Okay, probably not enough supply. Okay, great. Everyone understands that. But in the short term, we have a few things. The short term, copper is a function of risk sentiment in a certain sense, risk on, risk off. What does copper prefer in the short term? Positive news out of China, positive risk on, a slightly softer US dollar, supply interruptions, maybe a strike in Peru or Chile, where a lot of copper comes from. This kind of stuff, supply interruptions. Okay. In the short term, though, you have to look at technicals, and also we know that Trump, remember I was talking in some of the videos, if anyone watches them, that Trump back in 2025 was saying, remember this spike up here? Again, daily chart, spike up, because everyone was thinking that Trump was going to put tariffs on copper imports into the US. Then he came out and said, oh, actually, guys, I'm going to still think about that. So copper collapsed intraday, a huge move. Then basically he's like, oh, maybe I'm still going to do that. So copper's been going up, going up, going up, going up, going up. But look at the technicals. Okay, nice retrace. Rejected up here, Vitaly, rejected. So what I'm trying to say is that there's two things why this was rejected. And look at this big move down today. Why did we have a big move down today? Today, not over 6 months or 12 months. First of all, it's reached a very key overhead resistance. Everyone who's long here is taking profits. You're like, we're done. I made my $10,000. Yay, I made my 1,000 ticks. Okay. Secondly, a headline crossed mid-morning today, basically from Trump. There was a proclamation from Trump basically saying, hey, we're going to put some tariffs on various industrial metals such as aluminium. Yes, I do say aluminium, aluminium, copper, I think nickel, but there's going to be a lot of sort of exceptions. So the market was a bit sort of confused. The market went, hold on, you're going to put tariffs on, but not nearly blanket tariffs. Therefore, the whole reason for pumping up the price of copper went down a little bit. Plus, it's at a technical resistance. So guess what the market does, Vitaly? Boom, it sells. Boom, copper went down about 200 ticks mid-morning today. Hopefully, I was exactly at that level. I heard that news. I said, oh, that's not perfect for the market. Quick little short. I was in and out of the trade in 20 minutes. Okay. Now, I'm not saying that to go bravo, Angus. I'm simply saying that if you want to be a day trader, don't have a long-term time frame, because there's a lot of the problem on Twitter and Substack. There's a lot of intelligent people who are constantly trying to prove that they're the most intelligent person in the room. They're like, well, copper is going to be in 5 years, copper's going to be at $8,000. You go, great. What are you doing today? I don't trade that way. Avoid the temptation to make long-term prognostications and predictions. The way I trade, because I'm a much shorter term trader, I do a lot of trades over intraday, a few days. On options, I might trade multi-day or multi-week. Very rare for me to hold a trade longer than 5 or 6 weeks, because I just don't trust the world. I just don't know what's going on in the world in 6 months. That's me. I'm not a hedge fund at this point, trading 2 years into the future. So my point, Vitaly, is the following. And this gets back to the other question, which is, hey, well, how do you prepare? I make it a point to know the broad brushstrokes of what's going on in the world of, let's call it, trading and geopolitics. Copper, gold, US dollar, the Fed, monetary policy, sentiment, that kind of stuff. I constantly look at charts, not that many, maybe 30, 40, 50 charts. Stanley Druckenmaier used to look at 250 charts every afternoon, right? You just go through them. You see opportunities. What I try and do is to make sure that I'm not doing anything dumb. What you don't want to do, Vitaly, is to be long or short if the fundamental news in general, and specifically that day or that week, are against your trade. You don't want to enter a trade against fundamentals. So for me, ideally, before I click a button, I go, is there any medium-term fundamentals against me? But more specifically, are there any, short-term fundamentals against me? Right? So in terms of my daily preparation, the other thing I would say, again, I'm not giving you the full answer because it's a very long answer. And I might do a video because I know someone here, like, for example, Pascal, there's a lot more to say. You also have to understand which markets you trade. I have a limited brain power and time, more to the point. Am I interested in all kinds of stocks, markets, stuff? Yes. Do I understand them? Yes. Do I have time to fully invest in them? No. Personally, actually, forget about me. What one needs to do is to sort of eliminate stuff. You got to basically say, what am I going to do? I'm going to trade single stocks. I'm going to trade FX. I'm going to trade this. Personally, I know exactly what I trade. I trade bonds. I don't trade all bonds. I trade US bonds and European bonds. I trade maybe 10 FX pairs. I trade gold, copper. Silver is too crazy for me. I trade gold and copper. And I trade stock indices in the US and a few ETFs. Okay? That's all I can cope with. I can't cope with knowing everything about, Palo Alto and everything. It's not to say I don't trade single stocks, but less so. So therefore, my preparation is to understand what went on overnight, to understand, very important, the risk. Is it risk on? Is it risk off? In general, sometimes it's neutral. Then I'm always aware of technical levels. I'm always aware of technical levels. The point is that one needs to understand the narrative. Number two, one needs to understand the trigger, right? Remember, I was saying this, I think, to John the other day. No one cares.
Quick question.
Go ahead, Karen.
When it's neutral, like you don't trade, or
no, neutral is actually quite good. Well, first of all, neutral is information. It's also understanding that if something is neutral, it's also not bullish or bearish, or it's not risk on or not risk off. So that tends to put my brain a bit more into range trading and also more into sort of technical levels and starting to look at very key ranges. And to be brutally honest with you, Caroline, I also have a range of trades I do which are short volatility trades. And I'm not going to go into too many details, but for example, it's basically selling options. So selling put put spreads and things like that. So if I feel that, for example, the ES is ranging, I actually almost every day sell put spreads on ES futures. It's like a separate way of trading for me. It's almost like a strategy, shall we say. And sometimes with relatively low VIX, that's a good strategy. So my point is that if it's neutral, one could say, okay, low volatility. What does that mean? Remember, there's the very two first decisions one could make about trades is, do I expect movement, price movement, volatility, or non-volatility? It's not even direction. Do I expect volatility or neutrality? Now, having decided that you expect volatility, one can then get into sort of questions of direction and which kind of volatility. But you see the point I'm trying to make, Caroline. The point is that it's completely, if it's a choppy day, people go, oh, it's a choppy day, I don't like it, no trade. That's completely wrong, in my humble opinion. It just means you go to a different playbook. The playbook in that case would be maybe, okay, I'm going to try and identify ranges. It actually gives me a great sense of comfort. If I think that the ES, like let's say NASDAQ or whatever, is going to have a big problem breaking out of a range, that's beautiful because A, I can sell options, or B, if I'm doing directional trading, I can short at the top of the range and go long at the bottom of the range. So the point is, Caroline, if you have a neutral day, that gives you information a little bit about potential structure of the trade, right? I hope that makes sense. But again, there's a lot of stuff to unpack within that sort of box, shall we say. But Vitaly, getting back to the overnight preparation. So I just want to know what's going on in my markets, right? So I know what's going on in my markets. I'm constantly looking at, okay, and then I'm seeing if there's going to be a specific catalyst, a specific trigger. It doesn't matter if I like gold. The point, guys, is that there's two ways of trading. Some people like to go, I understand what's going to happen with, I don't know, Tesla or gold. And I don't care if no one else understands it. They're all dumb. I'm going to get in early and I'm going to be proved right. That's not my mindset. My mindset is to maybe hold a loose opinion, or maybe even a strong opinion. But in my humble opinion, one needs to have a trigger, a technical trigger. You need other people to agree with your point of view or your thesis. So for me, I'm always looking for attractive entry points and evidence that something's starting to bubble away. So therefore, I look at technicals a lot, especially for entry points. That's why, so I look at a lot of, so the thing is, Vitaly, to be honest, every morning when I literally sit down to my desk, I look at daily charts for about maybe 30 different instruments. That sounds like a lot, but the point is that the daily charts, they don't really change that much. Like I have my levels, and it's very simple. I have very simple levels, big levels, and maybe I change them a bit, but basically they normally don't change too much. So for example, let's look at one. Let's see, maybe I don't want you to think I'm lying, but for example, okay, well, there you go. There's copper. That's my daily chart, right? So what you observe there is that I have key information. What for me is key information. I'm like, okay, there's an uptrend. This is a key level. That is a key level. This I identified as a key level. And look where it's came back to. And I also, I did a Fibonacci there. And actually, I was saying this morning that this could be good for the bulls to come in here, right? That is what I mean by daily charts. I have about 25, 30 charts like that. And I just look at them and I'm constantly going, okay. And the thing is, and then I have 30 minutes. And on my 30-minute charts, which is slightly different, I'll look at, let's say I'll put it on, I don't know, ES futures. I have a different way. So there's my daily chart for ES. I have what I call a value zone. I have a key level. But you see, it's very simple, right? I also, of course, I'm a big believer in EMAs. I just keep a sense of where the exponential moving averages are. But I'm also checking, I have different, like I just have a quick look. I look at the Bollingers. I go, okay, it's getting towards the top of the Bollingers. If you look at NASDAQ, where is NASDAQ? It's getting to the top of the Bollingers, et cetera, et cetera. So for sure, I look at a lot of technicals, but basically I keep it relatively simple. And then I put it on the 30-minute chart, and you see I have more detail, right? You see there's more detail. So for example, today was a great day of when is the ES going to bounce? Now, look at this. There's another trade I did, day trade today. Okay, so, I see I identify levels. And so basically my logic was, if it breaks through here, it's going to go down here or here. And I didn't know. Right? But I actually went long there. I'm not saying I actually went long there. It was pretty crazy. I don't know if I'm going to be right. But you see, so the point is that what I do, I look at the daily charts, and then I put more detail for the same charts on the 30-minute. And also, to be honest, I have a specific, what do I call it? I call it something. Oh yeah, 30 minutes plus volume profile plus RSI. So on my 30-minute chart, I have a certain template, which I actually don't use the RSI on the 30-minute too much. But, you see, it's a little different. I basically have, you see how it's a bit different? It gives me more granular information. I have the volume profile for the days, and I have the overall volume profile. So my logic was, that's a beautiful point. I don't think today that the ES necessarily wants to puke down here, although as we speak, it looks maybe Broadcom was bad. You see? So the point for me is that I know my markets. I constantly look at the dailies. I look at the key levels. Then I look on the 30-minute chart, and I'm looking for particular entry points with good risk reward. And then, of course, I'm constantly monitoring all the news. So I don't do anything dumb. Like, I'm not going to go long ES if, I don't know, World War III breaks out, or NVIDIA, the CEO of NVIDIA, overdoses on caviar or something, or whatever Jensen Huang, you see? So I use the fundamentals as almost a check. It's like, am I doing anything dumb? And of course, if there's fundamentals in the background, it's nice. I trade quite technically in a sense. And that's it. It's pretty simple. And the point is, because I've done this for a long time and I do it every single day, and that's the reason I do my morning video, by the way, is because that essentially is my notes to myself. So it's my discipline. It's my hygiene. I force myself to do it publicly because you guys love me, not really, but that's the point. That's kind of my personal discipline, to force myself to articulate what I believe are the questions the market wants answered. And generally, remember what I said at the beginning of this little video, the market is a 12-year-old boy who's constantly asking questions. And the 12-year-old boys focus, sometimes the market wants to know about Italian bonds versus German bonds. Sometimes it wants to know about NVIDIA earnings. Sometimes it wants to know about the Strait of Hormuz. Who amongst you were experts on the Strait of Hormuz 6 months ago? I think Altaf knew about that. But not a lot. Now suddenly everyone's like, oh, tanker traffic in the Strait of Hormuz. That's also the thing, Vitaly, is that it's very important to understand. This is very important, guys. Not what a market should be, but what are the factors which will cause a particular market to move? Got to understand, what are the factors which will cause a particular market to move? Right? Your job is not to understand the entire world. It's too complex. Your job as trader, in my humble opinion, is to understand the 3 or 4 or 5 factors which will cause copper to move. What's going to cause oil to move? What are the 3 or 4 input factors which will cause the 2-year yield to move? Then, sometimes, Vitaly, I will actually do a bit of extra research on that particular thing. So obviously, I mean, because I've traded oil for a long time, I know about the Strait of Hormuz, but let's say in that kind of situation, immediately I'll do, and now with ChatGPT and whatever, Anthropic and Claude and everything, it's very simple. You go, bang, I need to know very quickly how much oil is coming out of the Strait of Hormuz. It takes 2 seconds. You go, okay, great, that's important. So the point is that if you're trading, I always make sure that I have a little extra information. I don't do it all day, because my brain will explode. But so for example, that thing on copper and Trump and the tariffs, I was a little unsure about the timing of that, and the implications. So I did a quick check, a bit of quick research. So I'm like, okay, I don't want to do anything dumb. And then I double check it with the technicals. But we can talk a lot more about that stuff, but that's it. But you got to decide your method of trading. Some people are purely technical, some people but what I'm trying to say, if you want to be a fundamental trader and a macro trader, yeah, and so just also the other thing as well, how to go from macro to micro, it's understanding, I mean, that's a big topic, but it's also understanding instruments, right? So for example, a very important part of trading is to understand the best way to implement something. So let's say copper futures are a little bit nasty. You go, okay, what are the main copper companies? So you've got Codelco, or you've got, Southern Copper, or McMoran Freeport, or you've got COPX, copper miners, global copper mining ETFs. So another very important thing is to understand the expression. Do you want to be a directional trader? Do you want to be a spread trader? Do you want to do options? Which is great as well. Okay, talking about options, but Vitaly, there's more to talk about, but that's a very brief introduction. Shalita wanted to know about Interactive Brokers. The problem is after 4 o'clock, although, hold on. Let's have a look. Let's see. That's probably another chat, guys, because the cash market's closed. Can you guys see, can you see this?
Yes.
Okay, so what are these? This is the option chain for ES futures. So options on futures, which is what I trade a lot. So what's the question? How do I can't say how I trade this stuff because that's like a 20-hour chat. I guess maybe one way, I mean, you're more, can you see, are you interested, Shalita, in the layout? I mean,
in the layout,
well, I mean, it's a whole other thing, but just very briefly, for example, first of all, one needs to be very organized, right? You see, I'm organized. Indices. You see, indices, subgroup, futures, micros, volatility, crypto, ES credit strategy. That's what I trade a lot. Individual stocks. I mainly trade the sectors, and I add stocks if I'm into stocks. Bonds and stir, you'll see I have US treasuries, I have short-term interest rates, I have European short-term interest rates, I have European bonds, I have Italian and German bonds, I even have an ETF, and I also have SOFR spreads, which are short-term ones. Then I have commodities, and you'll see that's energy, futures, metals, ETFs, and I have some spreads here as well. I also have FX futures there, and I also FX trading. Can you see FX trading as well? Can you see that?
the tab, yeah, I see it.
But can you see the actual page? Do I need to reshare?
Yes, I can see.
This
The
is
actual
for
page.
this is for spot FX. So I have G7 currencies, I have cross pairs for G7, and then I have exotics, which I amuse myself with sometimes. So that's my layout. So in terms of options, in terms of the actual layout, the way I have it, which suits me.
Is it a custom one or it's a template that you use?
No, it's all customized. I did it all myself. So I have the option chain here, which one can maximize. So it's much easier to, oh, hold on, why is that? There we go. So I like to have that. Also, you see here, I did all these columns in the way which I like. I also did the colors. I like, for me, I only trade on deltas, basically. So you see how I have my deltas in this nice turquoise color. I have my implied vols in a sort of a salmony pink. And then I have there's a mirror. So I have the ask and the bid, the delta implied vol, the theta and the gamma I use. And the delta dollars, a very important concept. So that's me. I have those up there. Then I have all of that stuff there. Then I have all the order entry here. So I have activity and the orders, which of course you can make bigger. And then I have the skew. So the thing is, you got to think how you trade, and you have to play around with it. and it should be, the thing is, because I've done it like that for a long time, it's automatic because IB is a little fiddly as a program or as a platform. So the thing is, once you establish the layout, it should be automatic. Like I almost don't, like I know exactly where everything is. So when I'm under time pressure, like I want to put on a trade quickly, I know exactly, that's why everything's super, super organized. Because I know if I want to put on, let's say, options on gold futures, I know I just go commodities, metals, gold, and it's going to have the front contract, and I click on it and it's going to open perfectly. It's very important. So before you figure that out, you've got to kind of really figure out how you trade, because I know the way I trade, for example. And then it's relatively simple because you can do on the IB platform, you can just, it's all customized. So you just start with a blank one and you open a new box. It's like options chain, and then it's the columns. It's not too easy. Like you just hover and it says, do you want to add a column? I mean, maybe we could do a private one if you want, a whole thing on IB, because it's really, I can't explain IB now because it literally took me about 3 years to figure it out. Like
I'm sure.
a
I'm
lot
sure.
of YouTube videos and just general nonsense because it's annoying.
And very overwhelming.
Yeah, but once you get into it, it's very sophisticated once you get into it. So it's actually good because you can do a lot of stuff. Like you do spread trades, options on, well, all kinds of options, obviously, but also options on futures. Like it's really a very professional platform. So yeah, but definitely I think one should customize it. But the first thing, you should go to a cafe with a piece of paper and a pencil and say, how do I like to trade? Yeah. Okay, guys, I'm not going to stop now, but I'm going to just stop recording.